Oil could hit $100 by Monday morning. Your mortgage rate decision just got more complicated, and Canada might be the only major economy that benefits from this war. Here's why. A few hours ago, the United States and Israel launched a joint military strike on Iran. The operation has a name, Operation Epic Fury. Explosions were reported in Tehran, Isfahan, Qom, and Kermanshah. Iran fired back. Missiles struck American military bases in Qatar, Kuwait, the UAE, and Bahrain. The conflict started this morning, and it is still active as you watch this video. And right now, oil tankers are avoiding the Strait of Hormuz. This is the story of what that means for your wallet in Canada. Let us start with the Strait of Hormuz because most coverage underestimates it. Every single day, approximately 20 million barrels of oil pass through this narrow waterway. That is roughly 20% of everything the world burns in a day. One channel. 1/5 of global supply. Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, and Qatar all export their oil through this strait. And Iran controls the entrance. Today, Iranian state media described the strait as effectively shut. Multiple major oil companies and trading houses suspended tanker shipments through the strait within minutes of the strikes, according to Reuters. Some tankers are already diverting. Is this temporary? Is this permanent? That answer will come Sunday night when Asian markets open. And the number on that screen will tell you everything about what the next few weeks look like. Brent crude closed on Friday at $72.87 per barrel. Rystad Energy says if there is no de-escalation over the weekend, prices could jump $10 to $20 when markets open Sunday night. That puts Brent above $90. A full Hormuz closure scenario? JP Morgan and UBS both have estimates in the $100 to $130 range. That is a 70% increase from Friday's close. Now here's the question most Canadian coverage is missing entirely. Canada does not import Middle Eastern oil. So why does this matter here? Because Canada is on the selling side. Canada holds the third largest proven oil reserves on the planet. Alberta's oil sands can produce for decades. And when Middle Eastern supply gets disrupted, the world needs alternatives. Canada is at the top of that list. Western Canadian Select crude already trades at a discount to Brent. That discount narrows during supply shocks because the demand for alternative barrels spikes. If oil hits $90, Alberta producers' profit margins widen significantly. If oil hits $100, the earnings picture for Suncor, Cenovus, and Canadian Natural Resources changes dramatically. All three trade on the Toronto Stock Exchange. And energy makes up 15% of the TSX. But that is only half the story. The Toronto Stock Exchange is structurally different from every other major index in the world. The S&P 500 is technology heavy. Apple, Nvidia, Microsoft. These names get hit hard when geopolitical fear spikes. The TSX is 17% materials and mining, 15% energy. Combined, that is 32% of the entire index. 1/3 of Canada's main stock index is in exactly the sectors that tend to gain during energy crises. Gold is the second engine here. When war breaks out, capital moves to safe havens. Gold is the oldest safe haven on Earth. Barrick Gold was trading near $61 per share in December. That was already near historic highs on the back of a gold rally that drove the TSX materials sector up 88% in 2025. A full Middle East conflict scenario pushes gold higher again. Barrick, Agnico Eagle, Kinross, First Majestic. All on the TSX, all gold producers, all positioned to benefit. So while S&P 500 investors watch their tech holdings take pressure Monday morning, TSX investors may be watching a very different screen. If you are still watching, this next section is the one most Canadian financial coverage will not give you, because it requires saying something that sounds uncomfortable given the severity of what is happening. Canada might actually come out of this in a stronger economic position than it entered. Let us go back to 2022 to understand why. Russia invaded Ukraine in February of that year. Oil hit $130 per barrel within weeks. What happened to the TSX? The energy sector gained 40%. Suncor alone gained 53%. Barrick Gold added 17%. Meanwhile, the S&P 500 lost 18% that year. That is not a coincidence. That is the structural logic of Canada's market playing out exactly as designed. This time, the conflict is not Russia-Ukraine. It is US-Iran. But the mechanism is identical. Supply gets threatened. Oil price rises. Canadian producers benefit. Gold rises as a safe haven. TSX energy and materials outperform. This is not guaranteed. Nothing in markets is guaranteed. But it is the pattern that the data shows. Now here is where it hits your daily life directly. If oil moves toward $90, gasoline prices in British Columbia and Ontario will feel it quickly. Current pump prices are running between $1.45 and $1.60 Canadian per liter in most of the country. At $90 oil, that range moves toward $1.80 to $2. At $100 oil, some regions could test $2.25 per liter. And here's the part that most people miss. Canada is a massive country. Everything you eat travels by truck. Trucks run on diesel. When diesel rises, the cost of moving lettuce from BC to Ontario rises. The cost of moving bread from a factory to a Loblaws in Toronto rises. We spent 2 years fighting inflation down. A sustained oil shock would bring supply chain inflation back, faster and harder than the headline numbers suggest. Because this time, it would be an actual supply disruption rather than a demand surge. This is where your mortgage enters the conversation. The Bank of Canada held its policy rate at 2.25% on January 28th. Markets were pricing in a flat rate environment for the rest of 2026. Most economists believed the bank had reached its terminal rate and would hold steady while watching the trade war situation. That was before today. There are now 3 scenarios on the table. Scenario 1, the conflict ends quickly. Iran does not fully close the strait. Oil normalizes within 2 weeks. The Bank of Canada stays on hold as planned. Mortgage holders see no change. Scenario 2, the conflict extends several weeks. Oil stays above 90. Inflation ticks back up. The Bank of Canada cancels any rate cut plans it may have been quietly considering. Variable rate mortgage holders wait longer for relief. Scenario 3, Hormuz closes fully for an extended period. Oil pushes past 100. Inflation accelerates meaningfully. The Bank of Canada is forced to consider rate hikes. Scenario 3 is unlikely right now. Analysts are not treating it as the base case, but unlikely is not impossible. And the Bank of Canada was already walking a tightrope between supporting a slowing economy and managing inflation risks from the trade war. Adding an energy price shock to that equation makes the bank's job significantly harder. 1.15 million Canadian households are renewing their mortgages this year. 60% of them are coming off 5-year fixed rates locked in when rates were much lower. At current rates, the average monthly payment increase is around $500. If the bank holds steady, that pain stays as expected. If the bank is forced to delay any future cuts, the relief timeline extends. If something forces the bank to hike, the math gets much worse. Watch the next 2 Bank of Canada announcements closely. April 2nd is the next scheduled decision. What happens in the Strait of Hormuz over the next 2 weeks could shape that decision. There is one more dimension to this that almost no coverage is mentioning. The Canadian dollar. When oil prices rise, the Canadian dollar historically strengthens. Canada is a major energy exporter. When oil revenues flow into the Canadian economy in US dollar terms, demand for Canadian dollars increases. That supports the Loonie. The Canadian dollar closed Friday at 1.38 against the US dollar. If oil spikes significantly, the Loonie could strengthen. That partially offsets the cost of imported goods that get more expensive during a global crisis. It also makes Canadian energy stocks even more attractive to foreign investors who are rotating out of US assets. This is one of the reasons Canada's economic position in a Middle East crisis is genuinely different from most other developed economies. Let us pull the lens back to the biggest picture. Prime Minister Mark Carney spent the last 6 months building 12 new economic partnerships across 5 continents: Europe, the Gulf states, India, Brazil, Australia, Luxembourg. He understood that Canada's single biggest vulnerability was overdependence on a single market. He built alternatives. He diversified. He created options. Now the world is experiencing a geopolitical shock that makes Canadian resources more valuable, not less. European markets that were already looking to reduce dependence on unstable energy regions will look even more seriously at Canadian LNG and oil alternatives. The Hudson Bay Trade Corridor project, which we have covered on this channel, gains new strategic weight as a route that bypasses Middle Eastern choke points entirely. Carney's strategy did not cause this crisis, but the architecture he built is exactly what a country needs when a crisis like this one arrives. Canada enters this period as a resource-rich, diplomatically active, politically stable nation with options. That is not a small thing. So where does this leave you? 3 principles for the next 2 weeks. First, do not panic, sell. The initial market reaction to geopolitical events is almost always exaggerated. When Israel struck Iran's nuclear sites in June of 2025, the S&P 500 dropped hard at open, then recovered within days once it was clear the strait had not been disrupted and no major supply outage was occurring. The same pattern could repeat. Second, look at your portfolio composition. If you are 100% in US tech-heavy index funds, this week's dynamics may work against you. If you have exposure to TSX energy or gold mining names, or to Canadian energy ETFs like XZEGA, the dynamic may look different. Third, do not rush your mortgage decision. If you have a renewal coming this summer or fall and you are about to lock in a rate, wait 2 weeks. Let the dust settle. Let the Bank of Canada's posture become clearer before you commit to a fixed or variable rate structure. Here is the honest summary. Today's strikes are the most significant military escalation in the Middle East in years. The Strait of Hormuz is partially disrupted. Markets have not priced this fully because they were closed when it happened. Sunday night will be the first real read. Canada is structurally positioned on the right side of an oil shock. TSX energy and materials, the Canadian dollar, Alberta's production capacity. These are genuine buffers. But Canada is not immune. If this becomes a long conflict that slows the global economy, commodity demand falls, and those buffers get weaker, we do not know which scenario plays out. Nobody does right now. The conflict is hours old. What we do know is the framework, and watching the right numbers in the right order will tell you how the story is developing. Watch Sunday night's Brent crude opening. Watch whether Iran confirms or denies a full Strait closure. Watch the Bank of Canada's language at the April 2nd meeting. Those 3 data points will tell you more than 100 headlines. And there's one more thing to watch that almost nobody is talking about right now. Trump said in his statement that the objective of this operation includes destroying Iran's navy and destabilizing its proxy networks across the region. That is not the language of a short operation. A short operation looks like the June 2025 strikes. In and out, targeted, oil spiked, recovered in days. TSX bounced, life went on. A long operation looks like something different. Sustained pressure, extended uncertainty, a geopolitical risk premium baked into energy prices for months. For the TSX energy sector, a longer conflict means a sustained earnings tailwind. For the Bank of Canada, it means a sustained inflation headache. For Canadian mortgage holders, it means the rate relief window stays closed longer. The duration question is the single most important variable right now, and the answer will not come from the headlines. It will come from whether Iran's government survives the next 2 weeks and whether the Strait stays disrupted. Those are the questions to keep in your head as this develops. We will cover this as it develops. Drop your questions in the comments below. And if this breakdown was useful to you, share it with someone who owns a home, has investments, or is about to renew their mortgage in Canada. This is the analysis they need right now. Thanks for watching Maple Money Talks. Stay informed.